Mr. Patrick Dalton. He's the President and Chief Executive Officer of Apollo Investment, a leading provider of investment capital for small middle-market companies generating both current income and capital appreciation through debt and equity investments. Welcome, Mr. Dalton.
Thank you, Chairman Altmeyer, Ranking Member Fallon, and Mr. Ellsworth. I'm very pleased to be here today. My name is Patrick Dalton. I am the President and Chief Operating Officer of Apollo Investment Corporation, an SEC-regulated business development company, commonly known as a BDC. For 5 years since our IPO, Apollo Investment Corporation has invested over $5.5 billion in 124 small and middle market companies across the U.S. And today, we have up to $700 million of available capital on our balance sheet. As successful as our company and our industry have been, I'm here today to let Congress know that the mission that this body gave to BDCs 29 years ago to provide much-needed capital to small and mid-sized companies is in danger unless prudent policy steps are taken now. I'm not here to ask for money. Far from it. I'm here to ask for some common-sense policy help so that we can use the money that we already have to originate new loans and to support the very companies that this committee feels so strongly about. But first, the good news. We estimate that the nation's BDCs currently have a combined loan investment portfolio of over $30 billion that provides capital to over 1,400 small and middle market businesses. These loans are the lifeblood of these Main Street businesses that support over 1.2 million U.S. jobs. In 2007, we estimate that the BDCs provided approximately 50% of all the junior debt capital loans, known as mezzanine loans, to small and mid-sized businesses throughout the U.S. As many of you know, Congress created the BDCs in 1980 under amendments to the Investment Company Act of 1940 in direct response to the crisis in the capital markets that threatened small businesses in the late 1970s. Today, we are in what many believe is a once-in-a-century recession. Small and middle market businesses have once again been abandoned by their traditional sources of capital. BDCs remain among only a few investment vehicles that are continuously dedicated to lending to small businesses. Our industry is lending in excess of $30 billion. None of us wants to see capital of that magnitude withdrawn from or otherwise unavailable to small and middle markets. It is our strong belief that BDCs occupy a unique regulatory space. Like banks, we originate, we structure, and we make loans directly to companies with the intention of holding most of these loans to maturity. However, unlike banks, we are much less levered, with a maximum leverage ratio of debt to equity of a mere 1-to-1. Further, we are required by statute to invest at least 70% of our capital in small and middle market U.S. businesses. And while we make similar, discrete, hold-to-maturity loans as banks, BDCs are obligated to mark-to-market 100% of our loans, while the banks only mark-to-market a minority of their loans. We are regulated by the same division of the SEC as mutual funds, but we are not a mutual fund. We do not trade liquid securities. Instead, we make individualized loans. BDCs have always used fair value principles to value our portfolio. Prior to the implementation of FAS 157 and its interpretive guidance, the industry used fair value measurements based upon underlying credit fundamentals. That is, the collectibility of interest and principal and the pricing of new mezzanine loans. Unfortunately, we have been forced by changes in accounting rules and auditor practice to fix what wasn't broken. The accounting community now requires that our illiquid assets be valued as if they were trading assets being sold into a hypothetical market, too often drawn from a series of distressed asset sales or other illiquid assets that are not at all comparable to our individualized performing loans. We believe that this practice has caused artificial asset value write-downs for the BDCs without meaningful regard to the credit quality of our underlying assets and has misled investors. And most important to the mission of this committee, the same accounting asymmetry results in many fewer loans and perhaps the cessation of all origination activities to the small business community by the BDCs. Every BDC finds itself hoarding cash rather than making loans so that they will not trip their statutory 1-to-1 asset coverage test that I mentioned earlier. Apollo Investment Corporation, I'm very pleased to state, has recently reported that we are in compliance with all of our covenants. Yet, we still must be cautious about using any of our $700 million of available capital toward making new loans. We have, therefore, voluntarily chosen to curtail new lending activities until such a time as that there is a resolution to this issue. This means that while we have the ability and the desire to lend, we're unable to do so because of the policy and interpretive guidance of FAS 157. As many of you know, the leadership of this very committee has written the SEC asking that regulatory reform be taken quickly before further deterioration occurs. But as of today, we are still in need of your help. We have made 3 suggestions to the Commission, and it is to those 3 suggestions that I want to return. First and foremost, we ask that the BDCs be expressly included in the work that the FASB and the SEC has been tasked with by the House Financial Services Committee to respond with improvements to mark-to-market accounting. If we are able to offer true value accounting for our hold-to-maturity loans, we could and we would resume lending. Second, we ask that BDCs be given temporary authority to raise preferred stock and treat those shares as equity rather than debt. And third, we also are asking for temporary relaxation of the asset coverage limits. In closing, let me end where I began. I'm not here to ask for taxpayer money. I'm not asking for a bailout of an industry that made bad decisions. I am here solely to ask for your help in returning us to the public purposes for which you, the Congress, created BDCs 29 years ago. It would indeed be a shame if common sense did not prevail. Thank you.